So that will get us, that's about $6 billion, potentially a little bit higher depending on what happens on the convert side. So that kind of gets us through the end of the year. So then, of course, the next question is what we do about next year, because we do suspect we will generate cash flow next year. So I'm delighted to announce that the board has authorized a $10 billion share buyback program. I was literally going to take my mic off and just walk out the door after this. Nothing more to say. Anyway, so let me give you a little details about this. So we will obviously transition now from kind of a delevering to more of a capital returns program. We'll initiate it at the beginning of 2019. The idea is that we will target at least 50% of our free cash flow in a year towards this program. So that's at least. So I'm really delighted that we were able to do this. I thought we had really great support from the board, I would tell you. Certainly great support from all the management team who also had to get behind this. And I think it really makes a lot of sense for the company, for the shareholders, and hopefully we can really enhance the returns. Okay, so let me give you a little bit of just overall capital philosophy, which this is kind of part of it. So, and I do this in priority. There's a reason why it goes in this kind of direction. So, number one, we have got to invest in the business. We do think there's tremendous opportunity. We do think there's good ROI for the business. And so, I didn't put it on here, but certainly R&D is definitely a big priority for us, as is capital spending, which we talked about. And we suspect we will spend in the low 30s as a percent of sale. Could there be years that it's less than 30? Yes. Could there be years that it's more than 30? Yes. But over time, we will average in the low 30s. And when you look at the industry, that is really similar to what the industry is investing. And Sanjay mentioned, the capital intensity required to be in this business is a meaningful amount. And so, we think that this is what's required to run the company. Second piece is we do want to maintain good liquidity, and I think that's very important. The idea and the philosophy around liquidity is really just to make sure that no matter what the economic situation, no matter what type situation we find ourselves in, we are always able to invest in the business in the manner in which we think we should. And so we targeted, kind of similar to CapEx, and there's a little bit of science to that, not very technical science, it's not Scott's science, but it's my science, that low 30s liquidity as a percent of sales makes a lot of sense, and it's kind of tied to the CapEx. Third, we have talked a lot about getting our cash to be higher than our debt, and that is exactly what we're going to do, and then we do want to maintain that. And then lastly, the big one, which is the cash return. And so, at this point, going forward, beginning in 2019, we'll target 50% of free cash flow, annual free cash flow, to return to shareholders. So that's it. I should point out, I didn't mention it, it's kind of in the footnotes, but let me just bring it out, is on the liquidity front, the way I measure liquidity, or whether the way we measure liquidity, is that's a combination of cash on the balance sheet and like unused line of credits, unused revolvers. And so we have about a $750 million revolver. We're actually looking to upsize that so that we don't have to have quite as much cash on the balance sheet. So it'd be a little bit more effective from an ROIC basis. So that's it. That's the new Micron from a financial perspective. We obviously are in the strongest financial position we've ever been in. I think I heard a quote one time where, depending on how cash flow works for us this year, it'll probably exceed all the cash flow we generated for the first 39 years of Micron's existence. So, we obviously will be grateful for that. And some of it obviously has been the market, but I would tell you there's a whole lot that's not the market, that it's our execution, our focus, our choices of products, our engagement with customers that's different than it has been in the past, and just this relentless execution. And I think that's really been the key to it. And so, markets, might move up and down over time, but really where we drive the most value is when we execute better than everybody else, and that's what we intend to do. And then, obviously all of this is for your benefit. It's for the benefit of the shareholders to drive shareholder value. Earnings are going to be a big part of it. I just remind you, $10 billion, right? If you can remember anything when you leave this room, $10 billion. So that's it. So with that, I will turn it over to Sanjay to wrap things up, and then we'll do some Q&A.